Hey, good evening, everybody, and welcome to this evening's Top 10 Stock Picks Sneak Preview. John Hopkins is unable to be with us tonight, so I'm going to go solo this evening. But I do want to welcome you. It's always a pleasure to have these events. We try to do these really from an educational perspective more than anything else, but trying to pass along a lot of the things that we learn in the market. I'm not going to spend a lot of time going through things tonight. Number one, because I'm still trying to sort some things out. I think we're at a critical time right now in the market, near term, and maybe even more intermediate term. And I did like the reaction today, the movement back to the upside. But most of the strength today did come from the NASDAQ stocks, which I think could have been more options related because options expired on Friday. And there were a lot of stocks in the NASDAQ 100 in particular that have a lot of interest in the option space. And as a result, could be reacting a little bit to all the selling that we've seen over the past couple of weeks. Typically, the behavior we see with options, if you look back historically on the S&P 500 since 1950, we tend to have, big moves to the upside from the 11th to the 18th. That's been a historical bullish period of calendar months. And then you go into option expiration week and even into the week following, and you can have some catch-up market makers, a little bit of manipulation. And so the 19th to the 25th historically has been a rough period for the market. This time it was different because we had a lot of selling from the 11th to the 18th, and that's what took our major indices down, where we actually had max pain levels above current price, which is a little bit unusual. And so part of the strength today is likely due to options expiration, but then we've also got the options activity that I've talked about over the last couple of days, showing that there's been an extreme level of pessimism in the market.
Which hey, Tom.
Bottoms. Yeah.
Your audio is echoing a little bit. Is the microphone a little bit away from your face?
It is.
Okay. Yeah, that sounds a little bit better.
Yeah, that's going to be a lot better. Thanks for that. Yeah. And so I think probably what we're looking at is in the short term, we're getting a little bit of movement back to the upside with options. But the bigger question is this going to last? Because I was looking at the small caps today and we didn't seem to get as much of a bounce out of the small caps. In fact, I think we may have finished in negative territory, although I didn't see the actual close, but let me check that out. Hold on one second. Yeah, small caps, the S&P 600 small cap index ended up finishing down about 0.43% today. Mid caps were up. NASDAQ, of course, had the best day, up 1.56%. S&P 500 was up about 0.7%. The Dow was lower, down 0.11%. So a lot of times when we get these bottoms in the market and we see a lot of that excess or extreme pessimism, we tend to get pretty big pops fairly quickly. So, we had a little bit of options activity, I think, that was playing in with options expiring Friday. I think we also had a little bit of that extreme pessimism that was kicking in. And so we're getting some mixed signals. And I just think that is something that we're going to need to continue to monitor here, at least over the next couple of days. So I don't really want to make any big announcements or bets on the market. I do think we're going higher. But I'm also, I'm not going to be stubborn about it if we start to lose some key support levels, especially 4,300 on the S&P 500 and the 20-week moving averages across all of our major indices. I think it would pay off to be more cautious in that environment. So I want to give the market a couple more days, but there's still some things I want to go over tonight that I think will be really important in terms of putting together portfolios as we move forward. And so that's going to be my focus tonight. I want to go through and just talk about some of the things that I think are likely to have an impact. And when it comes to interest rates, I've got a chart I'm going to show you that I think you might be a little surprised to see. But we're going to get into all of that in just minute. In fact, let me go ahead and pull the chart up. Our charts up. Okay. So you should have this very first chart. This is just the very short-term sentiment issues that I've been talking about. Back in the middle of July, when I thought I didn't know the market was topping. I just knew that the market had more risk. One of the reasons was that there were so many calls being bought relative to puts. And so we saw this 5-day moving average of the equity only put call ratio drop to 0.475. And if you look back, we had not seen a 5-day moving average that low since all the way back in April during the cyclical bear market of 2022. So it just told us, hey, in the short term, we need to be a little bit, careful. And by the way, even though it was a cyclical bear market, we're looking at complacency. Remember, we were coming out of some of the most complacent options activity that we'd ever seen. And so if you recall, this huge move in March of 2022, there were a lot of folks thought, okay, that little pullback was over and here we go back to new highs. And a lot of this had to do with options. We talked about this in mid-March. The max pain, when we got to mid-March, there was over $6 billion worth of net in the money put premium in mid-March. And so we were looking for a bounce heading into the second half of March. And that's what we got. The S&P 500, you can see the big rally there. But that big rally, everybody jumped on board again and started getting overly bullish. And so we saw this reading, which was very complacent, and that marked this top. Well, you can see in mid-July, we didn't exactly mark the top, but we got pretty close. I mean, the S&P 500 got up to about 4570 just as we hit this level. And we ended up going up maybe another 20 points, 0.5%. But that was about as far as we could get before we finally needed to correct. But now look at what's happened. Everybody, because of the cyclical bear market, and because everybody thinks this market has to go lower, and of course you've got a lot of negative news, all the headlines out there are negative, most of them. Now everybody's looking at this and saying, whoa, now market's got to keep going down. It can't possibly recover. We got too many issues. My goodness, 10-year treasury yield today closed at 4.34%, highest level since 2007. I dare you to go to any media outlet, financial media outlet, and I guarantee you're going to see a headline, something about mortgage or the 10-year treasury yield, which has an impact on mortgage rates, sitting at a 17 or 16-month high, or year, sitting at a 16-year high. That's going to be on financial news media outlets everywhere, including CNBC. First thing I saw when I pulled up CNBC.com was 10-year treasury yield highest since 2007. I mean, they've had that thing sitting back on the back burner just waiting for yields to break out so they could post that. And the bottom line is, I'm going to show you a chart again a little bit later on interest rates. I think you're going to be really surprised to see the correlation between interest rates and the stock market. I think most of you will be surprised to see that. Anyhow, last week, we got this 5-day moving average to 0.85. And if you go back, this is the last 2 years. So this was through the cyclical bear market and everything. In the midst, at the very low of the cyclical bear market, the 5-day moving average of the equity only put call ratio hit 0.85. We go down for 3 weeks and everybody thinks we're right back, heading into a bear market, because folks get complacent. They get used to the market going up, and every time it goes down, it's like, oh, here we go. We're going back down again. It's okay to have a pullback. Many of these stocks that pulled back, especially NASDAQ stocks, had huge run-ups in the first 6 months of the year. Again, a lot of this is about perspective, keeping things in perspective, not listening to every news story, chasing every downtrend or every decline in the market. Again, a month ago, we were talking about I didn't know we were going to drop 10%. Had I known, I certainly wouldn't have been buying any or transferring from the IWM to the TNA. I would have just gotten out into cash. Heck, if I'd known it was going down 10%, I'd have shorted. But you don't know. You just know that the risks are higher. I mean, I've seen the market ignore plenty of warning signs in secular bull market advances. So the whole idea behind talking about the warnings last month was just letting you know that, hey, we've run a lot. And again, it's all about perspective. Would it be awful if we pulled back 5% or even 10%? Not when you look at the long-term picture. I mean, if you were in last October or last June, June is when I called the bottom last year. I mean, if you were in mid-June and you had been long since then, in 13 months, the S&P 500 was, basically up from 3,700 and change to 4,500 and change. It's 800 points. That's probably close to 25% in 13 months. If you're up 25% in 13 months, you don't mind giving back 10%. Or in the case of the S&P 500, hasn't been 10%. It's probably been just a little over 5%. NASDAQ's been a little bit higher. Anyway, again, it's all about perspective. So I'm looking at this and I'm, when I'm trying to think about putting together these portfolios, my mind is thinking, okay, well, we've got a lot of pessimism that's come into the market. We are in the August-September timeframe, which historically is not great. But the annualized return for this period from July 17th to September 26th, the annualized return of that period going back to 1950 is minus 2%. It's not minus 40%. Since 1950, the S&P 500 has gone up an average of 9% a year. So you have to understand, if it normally goes up 9% annually, and we're in a period that has an average annualized return of minus 2%, this period actually performs. I mean, if we had to stretch it out and live through 12 months of it, it's underperforming by, on average, about 11% a year. Again, if we're taking apples to apples, annualized returns from July 17th to September 26th, if we're comparing that to the average annual return, we're about 11 percentage points shy of that. So it's just telling us it's a weaker period, that we tend to see weakness. Doesn't guarantee weakness. And I would certainly say that this drop we've had, we could probably recover 6 or 8% on the S&P 500, and still it would be a down period from July 17th. So I'm not reading too much into that. It's not like every July through September we drop 20%. I don't want anyone to get that impression. And like I said, we've already had the weakness. We've seen a lot of weakness so far. So I believe we're going to turn and go back up. Are we going to turn from here? My guess is yes. Could we go a little bit lower? Yeah, I think we could go lower. I think if we lose 4,300 on the S&P 500, I'd probably be in cash. At least until we return back up, maybe back above 4,400. I think there's, this 100-point range on the S&P 500 is going to be pretty important. So far, we're holding. I think that's great. But if we go back down, it would probably make sense, especially for those of you that are more conservative. I think it would make sense to be in cash and not worry about losing the next 2% to the upside. Protect against the possible 10 or 15 or 20% to the downside. That's what I would be more concerned with if I was conservative, very conservative. I tend to be a little bit more optimistic about the market. I tend to be a little bit riskier when it comes to the market. When my signals say to be in the market, I tend to be in the market. And right now, my signals are saying, especially the short-term signal you're looking at right here, look at these tops on the 5-day moving average of the equity-only put-call ratio. Every one of these tops with a green arrow, look at where the S&P, what the S&P 500 did after that green arrow prints. I mean, I'm not making this up. This is actual facts of what's happened over the last 2 years. And you go back 15 years and you'll see very similar results. When everybody gets bearish, short term, that is generally a time when the market is going to rebound. So even if we end up going below 4,300 on the S&P 500, I'd be very surprised if we don't have a bounce between now and then. But I believe we're going to keep going higher. I don't think we're going below 4,300. I think it was 4,305 when I talked about the market. 4,305 was an area that I thought we broke out from. That was the August high, which, by the way, that top coincided. It was just before the Jackson Hole speech of Fed Chief Powell. Well, guess what this Friday is? It's going to be the Jackson Hole speech by Fed Chief Powell. So this was about 2 weeks before he spoke. This top right here would end up being about 3.5 weeks before he spoke. And if there's one thing that bothers me about the market, if there's a wild card out there, I think it's Jay Powell. Because, I mean, I don't have a whole lot of confidence in him and the Fed, and you can feel free to disagree. That's fine. But he's made too many statements for me where he's gone back on his word. You know, when we saw inflation first popping up, he was saying that, hey, we just needed to see inflation start to roll over. We started to see inflation roll over, and then he changed his tune. He said, well, then, you know, we really need to see more than just 1 month. We need to, and that's how it's continually been, it seems like to me, over the course of the last couple of years. It seems like they come out, they say one thing, and then, well, this is kind of what we meant. Not really what we said last month, but this. I mean, they talked about not that long ago that they really wanted to see that the number that we were heading back toward the 2% inflation target. We were over 6%, 6.5% on the annual rate of core inflation. We're now at 4.7%. And now he's talking about raising because they're still worried about inflation. That's not what he said a while back. I mean, he was talking about seeing inflation moderating and moving. I mean, I'm just looking at the core CPI, but to me, it's moderated and it continues to moderate. The readings on a monthly basis have been pretty nil for the last 2 or 3 readings. I think we've been around 0.2 or below on core CPI. So anyway, he's going to be talking on Friday. So yeah, I'm a little nervous. I think if there's one thing that could spook this market is if he says something that's a little bit off from what he's been saying. If he starts talking about, hey, you know, we're getting some signs that I think we're going to have to maybe raise rates the next 4 or 5 meetings. If he were to come out with something like that, I'm not sure 4,300 holds. Anyway, I think that's going to be a big variable as we go forward and into the end of this week. Unfortunately, we'll probably do our draft the day before he speaks, which makes it really difficult. But I may change that. I may wait. We may end up, you know, having the actual draft after Thursday evening. I don't know. I'd kind of like to hear what he says first before, or maybe just leave open the possibility that if he does say something, we might get right back out of these portfolios pretty quickly. I don't know. Probably be one or the other. But anyway, this is a key chart. I think from a sentiment perspective, I use it as a trader. I mean, it is my go-to. I love when we get these extended readings on one side or the other, because I can really start to get confident about my position, whether it's on the long side, short side, or maybe just moving to cash. If I'm bearish, sometimes I just move to cash, or just getting out of leveraged ETFs, which is what we did back in mid-July. I mean, there's a lot of different ways to manage risk, but these signals are really important in helping us manage risk. I want to bring this up because I'd had someone write to me and say, hey, your long-term equity only moving average, your 253-day moving average is starting to turn back up. Does that mean the market's topped and we can expect lower prices? And I would just say, well, you know, we've got a lot of history here. I mean, we could see back in 2012, 2013, this top right here rolling over was the signal of a great bull market. But we did actually have a little hookup one time before we ended up going lower. So I don't think, and even here we did the same thing, had a little hookup and then went back down. I think when you're starting to roll over from this level, I do not believe we're going back up above that 0.73 level. I just don't think it's happening. That's just my opinion. Certainly it could happen. Anything can happen in the market, but I believe this top in the 253-day moving average really signals a bottom in the market, or signals a bottom has already been placed. Some of these tops coincide perfectly with bottoms. This one right here was absolutely perfect back in March 2009. We rolled over just when the S&P started to turn up, but they don't all. I mean, this one here, we had already bottomed back here in 2011. We got this signal came in after the bottom. This signal right here came in about, I don't know, maybe 5 months after the bottom. This signal right here came in 9 months after the bottom. This one came in, I don't know, maybe 5-6 months after the bottom. So it doesn't, some folks look at this as like, oh, when this rolls over, it's going to line up perfectly. That's not really the case. It's just telling us that the environment within the market has changed. Once you get to a level up here, just about everybody that's wanted to sell has sold because everybody's so bearish. And so when this starts to roll over, the sellers are gone. And that's why these big advances come on the heels of this, because we've lost all sellers. I mean, look at this rolling over here, big move to the upside, rolling over here, huge move, rolling over here, massive move every single time. I don't think this one's going to be any different. I think this is part of a very significant rise and that we're going to continue to go higher. So this is a little bit more big picture, a little bit more intermediate to long term, whereas the 5-day moving average is a very short term indicator. Let's see. Let's move on. I wanted to show you my intermarket relationships that I follow. This intraday QQQ versus Spider. Been keeping folks up to date on that. We're going to start maybe in September incorporating this in maybe once a week into our daily market report. I don't think it needs to be watched every day, and maybe not even every week, but probably monthly would be a good idea just to see what's going on. You can see in July, we topped. This is the intraday movement, ignoring gaps. So I'm just looking at from 9:30, once the bell is rung, from 9:30 in the morning to 4 o'clock in the afternoon Eastern time. What happened? Did the QQQ outperform the Spider, or did the Spider outperform the QQQ? During the trading day, what happened? And the reason I think this is significant is that you've got a lot of institutional money that changes hands. And I think you could probably call just about any money manager, and I think they'd all tell you the same thing. They don't put market orders to buy or sell in at the opening bell. The market's not liquid enough at the opening bell. They're doing their buying and selling during the trading day. And that's the big money. I mean, the portfolio managers, Wall Street, the big firms, Goldman Sachs, they're going to be buying and selling during the day. So when you're looking at relative strength intraday and you ignore gaps, it tells you a lot about the state of the market. I mean, you can see the QQQ had a rough fourth quarter of 2022, but look at it going down throughout the entire cyclical bear market. This is intraday, ignoring the gaps. So just looking at what was happening during the day. And we saw selling all the way until May. June, when we actually hit the low where I called the bottom, one of the reasons why was because intraday, and even including gaps, even if we include the gaps, both of these went higher off of the May lows. So
The S&P 500 went down in June, but money was rotating into more aggressive areas. The flip of what we saw back at the end of 2021. Remember, stock market went up and set a new high in the early part of January 2022. But look at the relative strength of the spider, including gaps. And even if we ignore the gaps, we were seeing money rotate away from the QQQ and into the SPY as we went to an all-time high. That was a warning sign on top of all the other warning signs we talked about. And that preceded a big move to the downside. Well, now we can see what's happened to the upside. I believe this is going to lead to more strength ahead. Now, just the past few days, you can see that the strength intraday has actually been better than the strength if we include the gaps. So I think for a little while, we were actually seeing some distribution. I think there was some profit taking that went on, but I'm not so sure it's continuing at this point. And some of the other charts I'll show you here would help to confirm that. So here's the XLY, XLP. Same thing. This ignores the gaps. This includes the gaps. Or another way to put it, this includes the manipulation of market makers. Because I think opening gaps to the upside and downside a lot of times are used to trigger retail traders into buying or selling. I think there's a little bit of coercion, when it comes to these gaps. So I just thinking when you're looking at ratios that include gaps, I think you're taking into account some manipulation. I think if you look at these ratios, these intermarket relationships, and you ignore gaps, I think you get a clearer picture of what's really happening in the stock market. I mean, if you look back at the end of 2022 and even into the early part of 2023, look at these highs that kept going in on the XLY, XLP ratio if we ignore gaps. If we included gaps, I mean, from here to here, look at this. We were almost even in May of 2023 with where we were in May of 2022. Almost dead even if you include gaps. And that's because of all those gaps I talked about in 2022. But look at what happened from May. I mean, here's the low in May of 2022 if we ignore gaps, and look at where we were in May of 2023. I'd say there's a pretty big difference. We were actually seeing a lot of buying during the day, but it didn't really appear in the price action because we were seeing so many gaps to the downside. And that's where, in my opinion, the media comes into play. It's all that negativity. When you see bad news and you keep seeing gap downs, it makes you want to sell. You're like, I can't take this pain anymore. But underneath the surface, I was getting all kinds of bullish signals. Now look what's happening here in August. So we topped mid-May, mid-June. Let's try it again. We topped mid-July in both of these, right? And we went down in both. This one, if you ignore gaps, is actually starting to turn back to the upside. We're higher than we were back at the beginning of August. Here, looks like we're just slightly lower than we were at the beginning of August. So again, the gaps are telling us one thing. Intraday buying is kicking back in again. Now, it's a very small sample and it's a very subtle move. So maybe that changes, but I'm starting to get, some signals that are telling me that the market's not in nearly as bad a shape as you might think by looking at, the decline that we've seen over the last 3-4 weeks. Now, the IWM QQQ is interesting because if you go back over the last, month, really since the market topped back on July 19th, if we include gaps, IWM underperforming the QQQ. If we ignore gaps throughout the trading day, the IWM is still outperforming the QQQ, even with the recent strength in the QQQ here over the last couple of days. And I think some of this this downside action, the IWM underperforming. I think a lot of that has to do because the QQQs, many of the stocks within the QQQ, I think are being bought because there was so much net in the money put premium because of the selling over the last 3 to 4 weeks. So I think the QQQ, because it's heavily, many of the stocks within the QQQ are heavily traded in the options world. I think they're being manipulated back to the upside probably a lot faster than the rest of the market, because small caps, most of them, they don't really trade heavily in options. Many of them don't trade at all in options. So I think some of this weakness is related to the August option expiry. And I wouldn't be surprised to see this turn back up at some point. Maybe it's later this month, maybe it's in September. But for right now, even though it's been coming down, you can see that the intraday is much stronger. It's just telling me rotation is going, we're seeing a little bit more rotation into the small caps versus the QQQ over the course of the last month throughout the trading day. Again, if we include the gaps, then you can see that it's been, the IWM is underperformed. So those were the most of the intraday charts that I wanted you to take a look at. Let's go ahead. And I want to show you, this is a really important chart. This is the 10-year treasury yield on the top. And then down the bottom, I have the S&P 500. The first thing I want you to do is forget about all the arrows. I'll talk about that in a minute. But take a look. You know, when you look at the 10-year treasury yield, you see it going down and the market going up, right? And then the 10-year treasury yield, well, especially over the last year and a half, really taking off to the upside, and we had the market weak. So at first glance, you'd probably look at this and say that the correlation between the 10-year treasury yield and the S&P 500 is an inverse one, right? Doesn't it look like they move inverse to one another? I mean, if you look at a long-term chart on the TNX, go back to 1980, the US 10-year treasury yield, where it was, we've been drifting lower. We've been going lower for over 40 years. Over those same 40 years, the S&P 500 has been going up. So again, you would probably draw the conclusion that these two move opposite one another and that we should be fearful of the 10-year treasury yield moving up. I want you to look at the correlation down here. So correlation, if you're not familiar with it, if two securities are highly correlated, and the period that we usually look at is a 20 period. That's the default reading. So here, this is a weekly chart. This is a weekly chart that goes back the last, I don't know, 18, 20 years. So this correlation is going to be based on how any two securities trade relative to one another over a 20-week period. Well, in this case, we just looked at this and we just talked about it, that there's probably an inverse relationship, right? Look at this chart. Look at the correlation down here. The red shaded area is your inverse correlation. This tells you how often the 10-year treasury yield and the S&P 500 move in opposite directions over a 20-week period. And I look at this and I say, well, it happens, but not very frequently. Then come up here to the blue shaded area. This is when there's positive correlation. In other words, over a 20-week period, this highlights the periods where the S&P and the 10-year treasury yield have gone in the same direction for a 20-year period. I see a lot more often that there's positive correlation rather than inverse or negative correlation. And if I was to, let's hold on a second. All right, so if I was to move this, and let's just take a look at the readings over positive 0.75 and less than minus 0.75, Look at the number of times we've hit plus 0.75. I'd say, I don't know, probably 15, 20 different times that we've either been there or approached being there. Look down here. 1, 2, 3. 3 times we've seen inverse correlation over a 20-week period, like serious inverse. When you start getting these extreme readings near -1 or these extreme readings near +1, this is when they're essentially going hand in hand with one another. In a 20-week period, that's roughly 5 months of the year. So when you look at this chart, you think that's can't be right. But I want to show you something. I want to start here in 2009. You see the 10-year treasury yield here during this period mostly goes higher. The S&P 500 went up 73.26% during that period when rates were going up. Here, during this extensive period, rates were going down this whole period. The S&P 500 went up 5% over a 2-year period. But when rates started to pick back up again and jumped, the S&P went up 45% over that year and a half. The next 2.5 years, rates were mostly heading lower. Stock market gained 9% over 2.5 years. Hardly anything. But then once we surged in the 10-year treasury yield, stock market went up 42% over 2 years. Then we fell precipitously. Market went nowhere. Then we had a quick pop in yields. S&P went up 17%. And then we hit the pandemic, which the immediate drop, you can see the S&P went down, and then the yields immediately came back to the upside, and we saw a big recovery in the S&P. And that's where the positive correlation has basically ended since the pandemic. And I think I have a reason why. But right here, once we got past the pandemic, a year after the pandemic, and we started to get inflation readings. Remember, it was the first quarter of 2021 when inflation took off unexpectedly. And at that point, look at the immediate inverse correlation that took place. So why? Why was it inverse? I mean, here yields were dropping, market was going up, but then the yield started to rise and it kept rising, and the market fell apart. So all of a sudden, it was doing the opposite of everything we had seen in the prior 10 years. But again, remember, this is when inflation started to become a problem. So at that point, interest rates, the Fed, they're trying to do a couple of things. They want to keep prices stable. So anytime inflation rears its ugly head, they are going to take that fairly seriously. The other thing they want to do is maximize employment. So they use interest rates to kind of, slow the economy down. So when the economy is really starting to heat up, the Fed starts raising rates. And as a result, you'll see usually both short-term and longer-term rates rising, not always to the same degree, but a lot of that, as the economy strengthens, you got to start building in perhaps a little bit of inflation or inflationary possibilities. And so you're going to start to see the 10-year treasury yield rise, not so much because of the economy, but because of inflation expectations. And once inflation triggered in February, I think it was February of 2021, where we saw that really huge spike. I think the core rate jumped about 7 or 8 tenths of 1% just in 1 month. And we had been used for the last 20 years going up 2% a year. We went up more than 2% in 3 monthly readings combined. So the Fed had to start dealing with the inflation worries. And in my opinion, that's why the stock market does not like inflation. The stock market does not want any threat of inflation. And once the stock market believes that inflation is no longer a threat, I could go back and show you multiple times in history when the rate of inflation rolls over and starts to go down, stock market goes higher. I mean, every time in history that I've seen. And so we saw the inflation drop, core rate of inflation at the CPI. That fell from over 6% down to 4.7%. And while that's been occurring, I mean, that's part of what's been driving the stock market higher, because the stock market's not worried about inflation. So when I talk about the Fed and what's coming up Friday, just keep in mind that if Powell says something that spooks the market, we could see another Fed related downturn. I mean, the stock market, remember, August of last year I think it was already on its way repairing itself. I thought the bottom was in June. We had the next 2 months straight up. Everything looked great. And then Powell came out at that August 25th. It was a Friday, August 25th, Jackson Hole, his speech from Jackson Hole. He said, we have more pain ahead. Talking about the stock market, which, again, Fed chief, in my opinion, has no business commenting on whether he thinks the market should go up or down. He should set the policy based on what he believes is appropriate, but it's just like Greenspan, back in 1996, talking about irrational exuberance. The market was up too much. Then we went on to post 4 of the best years in history consecutively after he made that comment. Stock market said, you don't know what you're talking about. You're not a stock market expert. And I don't like Fed officials that try to interject and try to become bigger than the market itself. It's kind of, I always use the analogy. I coached girls travel softball for years and years. And the worst thing, you want the girls to go out on the field and play and best team win. Worst thing, and if you've ever coached sports, probably know what I'm talking about. The worst thing is when you get an umpire who wants to be bigger than the game. And that's kind of what I felt like Powell was last August. And if he decides to pull it again, all the intermarket relationships can do what they want. But if he throws something out there that's unexpected and the market doesn't like it, we'll see a sell-off and we'll see support levels fail. So I think Friday is going to be a big deal. I think their next meeting is going to be a big deal. And he makes me nervous because I don't think he is consistent in things that he says that the Fed is going to do. And then what they end up doing is, even if it's slightly different, I just don't think the transparency of this particular Fed is what Feds in the past have been. And so he, to me, is a wild card. But anyway, this is a pretty unbelievable chart because the stock market, again, I'm not putting my spin on this. This is fact. Pull up the S&P 500 and pull up the 10-year treasury yield yourself and look at these periods. Common sense would tell you, well, if rates are coming down, that should be good for the stock market, right? It's not. Rates going up are good for the stock market because rates go up when the economy expands. And when the economy expands, S&P 500 companies make more money. And if you're making more money, the way valuations work, once your growth starts to pick up, your future growth rates go up. And when you start discounting back at, using much higher growth rates, you're going to see valuations move higher. Now, the relationship sometimes between growth and value can be impacted by sudden surges in rates. And we've seen that quite a bit over the last 2 or 3 years. And so that's another piece of this puzzle that we at least need to be aware of, when putting together these portfolios or when you decide to buy any stocks through any period. There's, some keys. I mean, growth stocks do like lower interest rates because they're being valued a lot on their future growth. And as long as their growth rates are going up faster than the interest rates that are going to be used to discount those earnings back, then you're fine. But it's when rates get to a point where, any slowdown, the problem is when you get rates too high, it starts to slow the economy down. You also get rotation. Investors move out of the stock market and into the bond market when rates get to a certain level. Now, the beauty of, essentially the 2009 bottom all the way through to where we are today, we have not seen rates over 5%. If you look back to where the last really bad secular bear market went down, that was in 2007, the yields were up over 5%. So there was a lot of things going on. I mean, obviously the banks were having problems. Housing market was a mess. We had a lot of loans that probably should have never been made, subprime loans. There was a lot of issues going back there, but being over 5% at that point, rates moving back up, as you can see, 2 or 3 years leading up to it, that was another one of the reasons why the market went down. So I kind of look at 5%. I think we're okay as long as we stay below 5%. And that wasn't what I was thinking probably a year or two ago. But if rates are going up for the right reasons, not inflation, if they're going up truly, if inflation picks back up again and rates are going up, that is not going to be a good development for the stock market. But I think inflation is going to continue to moderate. So if rates are going up, it's because what the Fed sees in terms of the economy is maybe a little bit stronger, which again, go back and look at history. When we're going up because of an expanding economy, the S&P 500 goes up. And to a significant degree, it goes up. So this is going to be an interesting meeting coming Friday, and really what happens to the 10-year Treasury yield over the next, not just the next week or month, but really over the next several months to couple years. I believe we're going to probably hit a point where we will moderate and rates will probably just go up and down, maybe in the 3 to 4.5%, 5% range. That's what I would expect with yields. So if those of you who are thinking maybe we're going to get this huge drop in mortgage rates, I'm beginning to think that's not going to happen. And that, again, is a little different than what I thought probably a year ago. I thought maybe we'd go back down to 2% or even maybe below. I'm thinking, I'd be shocked really at this point if we go below 2.5. I think 3 is probably, maybe these lows right down in here probably are going to hold us. You can see 320 here was a top, 3 was a top over here, 360 was a top over here, 340 was a top. And now that we went through it and we've got, been living above this 330, 320 area, kind of think that's probably where we're going to see support. I imagine that we'll probably just go sideways for a period of time. All right. That is essentially what I wanted to go over. We could look at a couple of other charts. Let me see if I can find another chart that I like to show. Market Vision 2022. I think I had some growth. Yeah, here's the, well, that's just small cap growth. I wanted to see more. Okay, this is one maybe that we can take a look at. When I select stocks for portfolios, I want to try to get them in. I want to get stocks within the areas I think are going to outperform the S&P 500. So as the S&P 500 has been going down here in August, one thing that's really interesting is that technology is actually outperformed. It's normally not what we see. If we go back here, let's go back 2 years. 2 full years. I mean, when we were in the bear market, the cyclical bear market, first 6 months of 2022, actually technically into the 9th, 10th month, all the way out here. But as we were going down, look at the XLK. Every time we went to a new low, see how the XLK relative to the S&P went to a new low all the way until about April. And then May and June kind of bottomed out. We started rolling back to the upside before we had one final low in the fall, which historically, technology, some of the aggressive areas of the market tend to not do so well in October and November. We tend to see a lot of money rotate toward industrials and financials. That's been the history. I think transportation stocks have been up during the month of November for like 14 straight years. So you get into the fourth quarter, you need to start thinking transports, other industrials, some of the financial areas, just because historically that's where they've been good. So as we rolled over here at the top, notice we went down, and we also went down on a relative basis on technology, which is what you expect when you get a level, when you get profit taking, you're going to probably see more profit taking in areas that went up more. So when you're leading to the upside during a rally, when you pull back, chances are you're going to start to pull back a little bit more than the S&P. But here over the last, I'll shorten this now. Let's go, let's just go last 3 months. So bring this into focus. This is where we were on the S&P when the XLK was at its low. We're actually seeing money rotate back into the XLK as the S&P goes lower. I can only say that from a history perspective and everything I know about the stock market and things I've learned over the years is if we're going to go lower, Wall Street's going to be prepared for it. In other words, we're going to see rotation out of technology. I mean, kind of see it here in the second half of July. Notice how the S&P was trying to go up, just like back at the end of 2021. Technology came down, XLY came down, XLC actually did okay, but these two both came down while we were moving up to that final high back in July. And then the S&P started going down. We're, for the most part, we've been going down with it. But this is telling me that, hey, maybe the XLK money is rotating back into the XLK because we're going to turn around and go right back up to the upside. This could turn out just to be a bullish continuation pattern that started off of this high. It could be a drop with a move back up to put in a neckline. This could be left shoulder, neckline, head. We could go back up to about 4,500 to 4,550, put in a neckline, maybe drop, 50 to 100 points, put in the right shoulder, and then come fourth quarter, boom. That would certainly make sense based on history and historical patterns. Maybe it's a cup. We've been going down, starting to roll back to the upside. Maybe we go into a cup that takes us into September, and maybe that last bearish period in September, maybe that's where we get the handle before the fourth quarter and we get a breakout. But I believe we're going higher once we get past September. And the portfolios that we put together are going to be from August, whenever we decide, whether it's the end of this week or whatever, through November, through probably about November. We'll probably get out November 19th. And remember, October and November, this goes back, and we'll just take a look seasonality. Let me show you the transports. So if we look at the transports, maybe it's the transports relative to the S&P. Yeah, transports relative to the S&P have gone up every year for the last 5 years in November. And we'll just keep going back. There's 6 years, 7 years, 8 years. Well, there was one that 9 years ago that fell. There's 9 out of 10, 10 out of 11, 11 out of 12, 12 out of 13, 13 out of 14, 14 out of 15, 14 of the last 15 years, transports have beaten the S&P 500 in the month of November. It's kind of a stat worth knowing. If we look at the XLI, which is industrials, and that versus the S&P 500, and we go back 13, 14, 15, 14 of the last 15 years, the entire industrial sector has outperformed the S&P 500. If we look at something like the XLF, and we go back the last, well, I mean, this is basically since the bull market began, 2013. That's when we broke out above the double top on the S&P 500. But these last 11 years, look at financials outperforming the S&P 500 in October and November by 3.1 percentage points. This is over 11 years. Let's add up all of the other months combined. So that's minus 0.3. That's going to, and I'm just going to do cumulative. So that's going to be plus 0.3, minus 2.8, minus 2.6, minus 2.7, minus 3.4, minus 3.6, minus 2.9, minus 2.5. So the financials relative to the S&P 500 have outperformed by 3.1 percentage points in October through November. But in all the other 10 months combined, they've underperformed by 2.5%. It's worth knowing. We're not too far, October, November. So the thing is now, when I'm putting together portfolios, I know that some of this is likely to help us in the portfolios. So I'm going to want to have some representation of financial stocks and industrial stocks because of the upcoming strength that they generally produce. Another factor in putting together the portfolios is at least paying attention to seasonality as a secondary indicator. So these are things we need to be aware of as well. Anyhow, that's essentially what I wanted to go over today. So that's keeping it to about an hour. We will continue to let our members know, and we'll let everybody know actually when we're going to actually have the draft. Right now, it is scheduled for Thursday at 5:30 Eastern. We will announce the stocks, 10 equal weighted stocks that go into each of our 3 portfolios. And then from there, we will actually purchase those securities on Friday at the close. So we announce it on Thursday. We used to announce it the same day we bought them. And members were like, well, I don't have an opportunity to get in at the same price. And that's why we started doing it a day before. So we'll announce them on Thursday at the close. And then effectively, we go in and we buy at 3:59.59 seconds, right before the close, and we get the closing price. That's how we base our performance. We base it off of that particular price being bought. But anyway, we'll have more of that later this week, and we'll keep you posted on that. I appreciate everybody tuning in. I know a number of you probably are just EB Digest subscribers. I want to thank you, for your support there. That means a lot to us. We do like to try to give back, try to teach things that we've learned over the years. And I think that EB Digest is a great way to do it. If you want to take, your trading and your knowledge to the next level, give us a shot with a 30-day free trial. We're now doing live trading classes on Wednesdays. They start at 10 o'clock Eastern, so a half hour after the market opens. You can join us. If you have a 1-month subscription and you get in now, you'll get the next 5 Wednesdays. You'll be able to join us for these live trading sessions. So anyway, lots coming up. It'll be a great time to join and become a member here at Earnings Beats. And we've had a lot of great calls. I mean, I think our market guidance is probably second to none. I don't know anyone who has called the market better than we have over the last 4 or 5 years. I think we've been spot on at Market Vision in giving future trajectories. I mean, calling a bear market at the beginning of 2022 before it ever begins. And while you're in the midst of a secular bull market, to call a cyclical bear, that takes a lot of conviction. But we did it. Laid out. I thought the market could go down, worst case scenario, from 4,800 to 3,500, and we ended up going to 3,491. So if that kind of market guidance is something that you think can help with your retirement plans, with your trading, again, make sure you check that out. So go over to earningsbeats.com, and right here you can click on that to start your no-cost trial. We would absolutely love to have you as a member at Earnings Beats. And again, you will have to give credit card, but there's not going to be charged anything for the first 30 days. So it'll give you plenty of time to check us out. Anyhow, everybody have a great evening, and we'll be back later in the week with our draft. Take care, everybody. Happy trading.